زكاتك تدفع عنك البلاء وتحفظ مالك أن أقام.
الحمد لله والصلاة والسلام على عباده الذين اصطفاه. Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome to part 10 of the short series on contemporary laws related to zakat. Today we will be discussing liabilities that can be deducted from one's assets when calculating the annual zakat liability that is due. Now, some of these are fairly complicated. Some of the issues related to these are intricate. And the objective of these sessions that we have is merely to highlight some of the principles to you, but it's always going to be best when you are calculating zakat for your personal or your business, and more so with your business where it gets a little bit more complicated, that you do check with your local mufti or local scholar to ensure that you are doing the calculation correctly. Now, in principle, there are certain liabilities that can be deducted from one's zakatable assets in order to determine the zakat base, as we discussed in one of the previous videos, that is to be used to calculate your zakat liability. So as a revision, we took zakatable assets less deductible liabilities, which gave us our zakat base, and we multiplied our zakat base by 2.5% on our zakat annual date, and that gives us our annual zakat liability that needs to be discharged. Now, some of the differences when it comes to liabilities is looking at current versus long-term liabilities. So that's one issue. And then there's also the issue of, have the liabilities been used to acquire zakatable assets or non-zakatable assets? Now, in principle, any liabilities that have been used to acquire zakatable assets will be deductible from the zakatable assets on your zakat date. So if you've got a liability for the purchase of inventory or trading stock, inventory is a zakatable asset. For example, you've bought it on credit and you're still owing the amount, you'll include the value of the inventory in your zakatable assets, but you will also be able to deduct the amount that is owing for that inventory because you have a liability that is used to acquire a zakatable assets. Another principle is that in your personal capacity, if you've taken out a loan for your personal needs, whatever that might be, that loan would be deductible from zakatable assets. Now, when we come and when we look at businesses, then typically liabilities that have been incurred for non-zakatable assets should not be deducted. So if you've got financing, even if it may be Sharia compliant financing for the acquisition of equipment in your business. Equipment is not a zakatable asset, so the financing may not necessarily be deductible. And just another note, when you do have Sharia compliant financing, it's important to understand the contract that you have with the finance house. For example, where you have a musharaka, all of the liability is not necessarily due at the time that you're calculating your zakat. The way that the musharaka financing generally works, and this is particularly in a South African context, but it may be similar in other parts, is that on an annual basis, the finance house determines, along with yourself, how much you are going to be repurchasing for them over the next 12 months. And it's only that amount that is actually a liability, because the balance of it represents equity that is owned in the asset by the bank. So again, something that you just need to check on if you have Sharia compliant financing. Now, when we look at personal assets, some ulama allow the deduction of liabilities used to finance both zakatable and non-zakatable assets. And generally, you're going to find that the liabilities will be more commonly related to non-zakatable assets. For example, in your personal capacity, you may have some form of financing for the purchase of your home or your vehicle. Both of those are not zakatable assets, but some ulama have allowed the deduction of up to 1 year's installments on those long-term liabilities, even though they may not relate to zakatable assets. Now, another question that often comes up is, should a person deduct his or her taxation liability? Now, taxation liabilities can only be deducted if they have been assessed by the tax authority. So if a person has filed their tax return and has the liability to make payment, and they haven't as yet made payment and the zakat date falls in between, then typically they would be allowed to deduct that because it is now being assessed. However, a person should not deduct an estimated income tax liability or an estimated capital gains on the sale of capital assets if the asset has not yet been sold, or an estimated income tax on the sale of inventory, or estimated penalties and taxation on early withdrawal of retirement savings. This would be the more cautious approach, not to deduct these and rather only deduct them when they become due after filing them with the relevant taxation authority. Again, there may be differences of opinion from different scholars, so check with your local mufti or your local scholar when you are looking at this if you're confused. But this would be the principle that you could apply in deduction of liabilities. So today we discussed deductible liabilities for zakat calculation purposes. We looked at the deduction of zakatable liabilities used to finance zakatable assets. We also looked at the differences between a business and a personal individual in terms of the deduction of liabilities, and also looked at the taxation liabilities that you may have. Subhanallahi wa bihamdihi, subhanakallahumma wa bihamdika, nashhadu an la ilaha illa anta nastaghfiruka wa natubu ilayk.
لذلك قال الرسول الكريم فلذ بالنداء تفز بالمرام.